Okay, we'll now start with the forward contract. This will be one critical area as far as entire international finance is concerned. So now what does a forward contract do is, you have to buy 400 kg, you have to buy 400 grams of gold, let's assume after a year. Now I am sure that I need 400 grams of gold, but the problem which I have in hand is I don't have money at this point of time. So I'll buy it later on, and when I buy it later on, I'm worried about one critical aspect, that is the exchange rate may change, the gold rate may change and it may become unviable for me. So today the price is 3000 per gram. After some time it can even become 3200, 3500. All this uncertainty is what making things difficult for me. So I don't want to live in this uncertainty. The uncertainty can lead to a huge impact on me. So on that context, when you look from a forward contract point of view, what happens is, forward contract is basically an agreement between two parties. It's an agreement between two parties to exchange specified currency at a specified rate on a specified date. So you will exchange $1 lakh at 65 rupees per dollar on June 30. That is what forward contract does. Forward contract will ensure that you are able to get 65 rupees per dollar on June 30, on July 31, on October 30. Any rate you ask for, the banker will give you the rate, and for every date there is going to be a rate. So there can be a different, and the rates are going to be different. So spot rate, today's rate will be 65. June 30 rate could be 66, July 30 rate could be 67, August 30 rate could be 67.5. So normally practically forex contracts are there for 6 months, also till 12 months, 1 month, 2 months, any period you want. You go to the bank and say that I want a forward contract, can you give me the quotation? So he will give you the quotation for the period which you are asking. Now with this contract, what I can do is I can be certain of my realization. I can be certain of my realization are payable. Practically 80-85% of the companies which they want to hedge their forex risk, they'll hedge it only through a forward contract. Easiest, simplest way of hedging your forward risk, exchange risk, because all other elements which you are going to learn, currency options, currency futures, all these elements has a lot of complex structures in place. So because of which a lot of companies may lose money, may make money because of not understanding the structure properly. Practically, predominantly used hedging tool is your forward contract. Yeah. Hedge is protecting against a risk. Now, the risk which I have is I may not catch the flight. So my flight is 2 hours later. The risk which I run is I may not catch the flight. How do I hedge myself against this? I hedge myself against this by starting from my home 2 hours earlier, 3 hours earlier. That is the hedge you are doing. Hedging is you are protecting yourself from any risk which exists. So there are a lot of risks which exist in the market. So any risk which exists, you have to hedge yourself from the risk. Hedging is basically protecting yourself from the risk. Practically, if I keep talking about, for example, I'll tell, why don't you give money to an unknown person? You will say, no, there is a risk against it. There's a risk I don't want to give. Now I'll give you a protection saying that if that person is not making the payment, I'll make you the payment. That is basically letter of credit from a bank point of view. Bank says, if your customer is not paying, I'll make you the payment. So that is where a letter of credit is coming in. That letter of credit protects me from a credit risk. Credit risk is my customer not making the payment. If my customer does not make the payment, I am impacted. So I can be protected from the credit risk by taking something called as a letter of credit from my customer. So there are multiple risks which exist in the market. For every risk, you will have some way of protecting yourself from the risk. There are certain risks which can't be protected, and because of that you generate a return. If you cannot protect yourself from the risk, it is not that by taking a forward contract I'm ultimately sure that everything is going to happen. I took a forward contract saying that I'll make the payment on June 30. My customer didn't make the payment itself. If my customer doesn't give the payment, how do I give it to the bank? Because to the bank I told, I'll give you $1 lakh, you will have to give me 65 lakh rupees. Bank agreed, everything done. I was expecting my customer will give me $1 lakh. He is giving only $50,000. He said, I don't have money, take 50,000, we'll pay you 50,000 later on. So everything will have a risk. Some risks can be taken care of, some risks can't be taken care of. Whatever risk you can take care of, that risks are taken care of through a tool called as hedging. Hedging is basically protecting yourself from the risks which are there. You have multiple risks which you will face in the real world. Some risks can be compensated, some risks can't be compensated. Helmet is basically hedge against an accident risk which we have. So helmet is being worn, so it will protect against some accidents, it may not protect against some accidents. So that is basically you are trying to protect yourself from the risks which are there. So that is where this forward contract comes into picture. Now if it remains as a normal forward contract, things are very simple. How do I analyze a forward contract? Everything is very simple. But in forward contract, later on you will understand about something called as cancellation of a forward contract, extension of a forward contract, all of that where the complexity will start it. So let's first start the basics of forward contract and then we'll go to the cancellation, extension, all those areas. Let's go to question number 1, topic 50. ABC Co. have taken a 6-month loan from their foreign collaborators for US dollar 2 million. Interest payable on maturity is at LIBOR plus 1%. 6-month LIBOR is 2%. Enquiries regarding exchange rate with their bank elicits the following information. What would be the total commitment in rupees if they enter into a forward contract? Will you advise them to do so? Explain giving reasons. Okay, I have taken a 6-month loan for US dollar 2 million. That's the amount of loan which has been taken by me. I have to pay some interest, everything. What would be my total commitment if I enter into a forward contract? The moment I enter into a forward contract, the USD loan becomes an INR loan. From an USD loan, it becomes an INR loan. Now, practically US loans will be at a very cheaper rate. Will be like 2%, 1%, 3%, all those will be cheaper rates. Like the Japanese loan which I was talking about, a 0% loan to India, all this will be at cheaper rates. But if you don't protect yourself from the hedging, from the risk associated with it, what can happen is the 3% can even go to 20%, can even become negative depending on how the currency moves. It can even go to 20% if the currency moves. If the US dollar appreciates significantly, you are gone. If the US dollar depreciates, the cost can be even negative. It can even turn out to be negative because your liability has depreciated. But you don't want to take all this risk, then you'll have to cover yourself. So practically what happens when somebody takes a forex loan, he will immediately do the hedging analysis. After the hedging analysis, you will get the effective cost of the loan. So 3% USD loan will turn out to be 10-11% INR loan. This 10-11 you compare with the normal INR loan. If that is cheaper, you go with the INR loan itself. It is better to go with a 10% INR loan vis-a-vis a 3% USD loan at times, vis-a-vis a 3% USD loan because of the currency risk and because of the hedging cost. The name which we normally use is hedging cost. What is the cost of hedging ourselves from the currency movements which can happen? In this case, they want to enter into a forward contract. They are asking what will be the total commitment in rupees. Let's start. Point number 1. The company has taken a loan of 2 million USD, has taken a loan of 2 million USD, and the total outflow along with interest, would be, can you tell me after 6 months what will be the total outflow along with interest? LIBOR is basically like in India you have base rate prime lending rate. Like that you have something called as a LIBOR, London Interbank Operating Rates. So that is the basis in which your international interest rates are set. So I'm going to take a loan as LIBOR plus 1%. What is the LIBOR rate? 2%. So my interest rate is going to be 3%. LIBOR plus 1%. LIBOR plus 1%. So the interest rate for my loan is going to be 3%. 2 million loan along with interest is how much? 20 lakhs plus interest. $20 lakhs plus interest. How much is the interest? 30,000 or 60,000? 30,000. That 3%. Let them use the word 6-month LIBOR. 6-month LIBOR also indicates that's the annual rate. You have 3-month LIBOR, you'll have 6-month LIBOR, you'll have 9-month LIBOR, you'll have 12-month LIBOR. Let it be anything. All of those are basically interest rate for a year. All of those are basically interest rates for a year. So it's 2 million, 20 lakhs into 3% into 6 by 12. 20 lakhs into 3% into 6 by 12. So the repayment along with what I've said, along with interest is USD 2.03 million. USD 2.03 million. USD 2.03 million. Next point. The company plans to take a forward contract. Plans to take a forward contract at the rate of rupees 48.4575 per USD. At the rate of rupees 48.4575 per USD. Full stop. This will lead to a total commitment of INR. Multiply and write. Write it in lakhs. Let it be in lakhs. 20.3 lakhs into 20.3 lakhs into 48.4575. 20.3 lakhs into 48.4575 into 48.4575. How much is this? Just a minute. What the total commitment? 983.69 lakhs INR. So we are now fixed the commitment. This will ensure that it's 983.69. It will not go up, it will not come down. That is what a forward contract does. It ensures that your outflow is restricted to 983.69 lakhs. Any doubts on this? Now the second part is saying, will you advise them to do so? Explain giving reasons. Now, if somebody doesn't want to take any risk, simple answer, go ahead and take a forward contract. Go ahead and take a forward contract. Now, whether to take a forward contract or not, it will all depend on what is my expectation. If I feel this 48.4575 which is given by the banker is kind of incorrect, and I believe that it will be 48.25. If my expectation is that after 6 months it's going to be 48.25 rather than 48.4575. If I believe it can be 48.25, then I may not take a forward contract. Why I am not taking a forward contract? Because it will become 2.03 million into 48.25. It all depends on what expectation I have. Practically, people don't try to speculate on all of this. They'll go ahead and take a forward contract and remain happy, because anything can happen. Suddenly if it touches 50, you have a huge payment. If it touches 45, you have an insignificant payment, or you save money on it. Now those risks are little difficult to take. Other way of understanding is spot rate is 48.5275, forward rate is 48.45. Does this mean dollar is depreciating or appreciating? Dollar is depreciating, appreciating? Dollar is depreciating. So institute has answered in this way, saying that considering the current interest rates in India and US, it will be unlikely to expect that dollar will depreciate. It is unlikely to expect that dollar is going to depreciate, and hence it is wise to take the forward contract, because we normally don't expect dollar to depreciate, we expect dollar to only appreciate because of IRPT. IRPT expects that dollar has to appreciate. So we are going to give 2-3 different answers. The first answer is you don't want to take a risk, go ahead and take a forward contract. Second, if at all you want to take a risk, then taking a forward contract or not will depend on what exchange rate are we expecting. If we expect dollar to depreciate more than 48.4575, then I should not take a forward contract. If I expect it not to depreciate to that extent, then I go ahead and take a forward contract. And then a general answer saying that considering the current exchange rates, it is unlikely that dollar will depreciate so much, and hence we should go ahead taking a forward contract. Now write point number 1. If a company does not want to take exchange risk, if a company does not want to take exchange risk, then it should go ahead and take a forward contract. It should go ahead and take a forward contract. Next point, assuming the company wants to take exchange rate risk, the decision on forward cover would depend upon the expectation of ABC Co. Full stop. If ABC company expects dollar to depreciate, if ABC company expects dollar to depreciate below rupees 48, dollar to depreciate below rupees 48.4575, then it should not take forward contract. It should not take forward contract. However, if the expectation is that dollar will remain above, rupees 48.4575, then we should take a forward contract. Now whatever 2-3 lines I've talked about after this, it's all because of exchange risk. If you want to take a risk only, all this is relevant. Next point, considering the current interest rates between India and US, it would be unlikely that the dollar will depreciate it would be unlikely that the dollar will depreciate, and hence we should go ahead with the forward contract, Clear? Any doubts on this? So as such, if you don't want to take a risk, currency invoicing said home currency. If you want to take a risk, then appreciating currency, depreciating currency, all that came into picture. Whether I want to take a risk, then I'll try to do it in an appreciating currency. Exporter take a risk, importer will want a depreciating currency. So it's always whether to take a risk or not. If at all you are not taking risk, go ahead, take a forward contract, and we are done with it. Next question number 2. A company is considering hedging its foreign exchange risk. It has made a purchase for which it has to make a payment of $50,000 on November 30, 2012. The present exchange rate is rupees 40. Purchase forward $1 at 39. Upfront premium of 2% of the forward amount purchase. Cost of funds is 10%. Corporate tax is 50%. Ignore taxation. Consider the following situation and compute the profit or loss the company will make if it hedges the foreign exchange risk with dollar touching 42 and 38. Please go through the question. Now considering this question, now what is going to happen in this question is the company wants to take a forward contract. What does a forward contract does is it will ensure that payment is fixed. Now in the last problem we said 48.4575. In future on the 180th day after 6 months, if it is 49, it's technically called as we have made a notional profit. Why profit? Because we are paying 48.4575 whereas it is 49. If it touches 47, we will feel that we have made a loss. We will feel that we have made a loss because I did a mistake by taking a forward contract is what you will feel after 6 months. You cannot get to know all of that today. Today though I talk about saying that go ahead and take a forward contract if you don't want to take any risk. Perfectly fine. After 6 months, I want to check whether what I have done is right or wrong. Then I will calculate something called as a notional profit or a notional loss. What is notional profit, notional losses? Payment made through forward contract vis-a-vis payment made through the spot rate. What is spot rate is after 6 months you will get to know what is the amount. So I have paid 900 lakhs, let's assume. If I had not taken forward contract, I would have paid only 870 lakhs. Then I'll feel I made a loss of 30 lakh rupees. I'll feel that I made a loss of 30 lakh rupees. Sometimes 900 is what you have paid, but if you had not taken a contract, it could have been 950 lakhs. Then you will feel you have made a profit. It's technically a notional profit, not a real profit, not a real loss. So in this question, that is what they are telling us to do. Now, future, what happens is beyond our control. So this never explains. See, though I can calculate the profit or loss after 6 months and then decide whether I make money, I lose money, whether the decision to take a forward contract was good or bad. It's like a post analysis. This practically is of no use as such. What can exactly happen is, sometimes you will lose money, sometimes you will make money, but your expectation was that you wanted certainty. If you want certainty, don't try to play with forex. So whatever profit or loss we are going to calculate now, it's kind of a book entry. It's kind of a book entry. Even it will not come in our books of accounts. It's outside the books. You are just analyzing it. It's neither a real profit nor a real loss for the company. Because why I took a forward contract? The reason for taking a forward contract is I didn't want exchange risk. If you don't want exchange risk, there's only one way. Go ahead and take a forward contract or use any other hedging tool. When you use hedging tool, whatever happens to the market, you are not impacted. That is what a hedging tool can do. Now, after taking a hedging tool, now you cannot come back and say that you did a mistake because the dollar has touched less than 48.4575. That is what we are going to do in this question. So let's first calculate at what rate have we covered, and then we'll see what is, at what rate are we going to cover the transaction. 39. The company will have to make an upfront premium of how much? 2% of the forward amount purchased. So I'll have to pay upfront premium. Practically nobody pays an upfront premium. There is only a booking charges which is done. Here they are saying you have to pay an upfront premium. So today I will pay a premium. After how many months is this? 4 months. Okay, after whatever is August, September, October. Yeah, after 4 months, you will have to pay the $50,000 into 39. $50,000 into 39. These two cash flows cannot be added with each other because premium is paid today. The normal payment happens after 4 months. So what you are going to do is you are going to charge interest on premium. You are going to charge interest on premium. Why interest on premium is? Because premium is paid today. Add interest on premium like LC commission. LC commission was paid on day 0. We charged interest on LC commission. We considered the final payment and then got to the overall amount. So working note 1, calculation of outflow through forward contract. Calculation of outflow through forward contract. Calculation of outflow through forward contract. Outflow through forward contract. Point number 1, commission on August 2012. Commission on August 1, 2012. Sorry, not commission, premium, sorry. Premium on August 2012. Premium is, listen, 50,000 USD into whatever rate we have agreed on. What is the rate we have agreed on? Into what is the percentage? 2%. That's not an annual percentage and all. Commission premium, whatever percentage they give, you do a normal multiplication. 50,000 USD into 39 into 2%. Rupees 39,000. Rupees 39,000. Next, interest on commission. Interest on premium. Because the premium is on the 2% of the forward rate. The premium is going to be 2% of the forward rate which has been agreed on. Interest on premium. Interest on premium. Rupees 39,000 into 10% into 4 by 12. How much? 1300. Any doubts on 1300? Clear? Next, payment on November 30. Payment on November 30. I finally will make a payment on November 30, which is 50,000 rupees 19 lakh 50,000. 50,000 into 39 rupees 19 lakh 50,000. Any doubts on this? Next, finally, total payment. Total payment. Total payment. How much is the total payment? 19 lakh rupees 19 lakh 90,300 OR. Can you divide by 50,000? 39 point or rupees 39.806 per USD. Every US dollar indirectly we are paying 39.806. For every dollar we are paid 39.806. What is the 39.806 is? 39 is the base price, 0.78 is the premium 2%, and the balance 0.2 paise whatever you see is the interest on premium. 39.806 is what I am paying by a forward contract route. The forward contract route gives you a payout of 39.806. Now 6 months have gone by, or whatever 4 months have gone by. Any doubts till now? After 4 months they are saying exchange rate is 42 and 38. 42 means are we making a profit or loss? 42 means are we making a profit or loss? Everyone's participation. Profit, because I am paying only 39.806 whereas everybody is paying 42. It is payable. If it was receivable then it would have been the other way around. So I am paying for 39.806, everybody else is paying 42. The difference is my profit. If it turns out to be 38, loss. Next, calculate. Next working note, calculation of profit or loss. Calculation of profit slash loss. Calculation of profit slash loss. In that, if exchange rate is rupees 42 per USD, if exchange rate is rupees 42 per USD, exchange rate is rupees 42 per USD. Now write profit slash loss equal to profit slash loss equal to, though I am giving a formula, you need not have any formula, payment using spot rate minus payment through forward contract. What could have happened is 50,000 into 42. What has happened is 50,000 into 39.806. What could have happened is 50,000 into 42. But because of forward contract, we got saved. 50,000 into 42 minus 19 lakh 90,300. So profit is rupees 109 700. Next, if exchange rate is 38, $90. This is kind of a notional amount because we have already paid whatever we have to pay. This is just to understand what has exactly happened because of a forward contract. In one scenario, we are indirectly making money. In the second scenario, we are indirectly losing money. That's what is the net analysis talking about. Any doubts on this? 109,700 profit, 90,300 loss. Can we proceed? Clear? Let's go through question number 3. A company operating in Japan has today effected sales to an Indian company, the payment being due 3 months from the date of invoice. Invoice amount is 108 lakhs yen. At today's spot rate, it is equivalent to rupees 30 lakhs. It is anticipated that exchange rate will decline by 10% over the 3-month period, and in order to protect the yen payments, the importer proposes to take appropriate action in the forex market. The 3-month forward rate is presently quoted as 3.3 yen per rupee. You are required to calculate the expected loss and show how it can be hedged by a forward contract. Okay. Somebody in Japan has done a sales to an Indian company. The payment is due 3 months from now. Today the spot rate is 108 lakhs yen is equal to 30 lakh rupees. So 108 yen is equal to rupees 30. Rupees 1 is equal to how much? So today's price is yen 3.6 per rupee. Yen 3.6 per rupee is the today's exchange rate. Any doubts till now? Now, I expect that exchange rate will decline by 10%. Now will decline by 10% doesn't make any sense to me. I cannot understand what is exactly declining by 10%. Is dollar depreciate, sorry, is yen depreciating, is rupee depreciating? All of that is a problem. We don't understand that. In order to understand that, because the 10% depreciation can be for yen, can also be for the rupee. I need to understand, is it a depreciation of a rupee or depreciation of yen, because that makes it more critical. How do I apply? If it's on yen, then I will have to maybe convert the quote and do it. If it's on rupee, I straight away apply, because our appreciation depreciation percentage are applied for the product. So yen 3.6 per rupee, if the exchange rate is there, you can straight away go ahead and deduct 10% from it if rupee is expected to depreciate. If rupee is expected to depreciate, I can go ahead and do it. Otherwise, I will have to interchange the quote and make it as rupees so much per yen and then deduct 10%. So I need to decide what is going to depreciate. Now for that, what they are saying, in order to protect yen payments, an importer would be worried about yen appreciation. Sorry, an importer would be worried about yen depreciation or rupee depreciation in this question. Think about it. You are an importer. A company operating in Japan has effected sales to an Indian company. So you are the Indian company. Will you be worried if yen depreciate or INR depreciate? What will be your worry? Yen depreciation, INR depreciation? Yen or INR? INR. Why INR is? My liability is in yen and I wouldn't want my liability to appreciate. So indirectly the question talks about yen appreciation. Indirectly the question is talking about yen appreciation. Why yen appreciation? Because my liabilities are expected to appreciate and I am kind of worried about it. I will be worried only when my liabilities are going to appreciate. So net the question talks about a 10% rupee depreciation. Net the question is talking about a 10% rupee depreciation. Once that is clear, if the rupee is the product, straight away deduct it. If rupee is not the product, convert and deduct it. We did this in IRPT. When we were doing IRPT, we did this analysis. Let's start point number 1. Indian company has bought the product. Indian company has bought the product from Japanese company. Indian company has bought the product from Japanese company. Full stop. The invoice amount is 108 lakhs yen. The invoice amount is 108 lakhs yen. 108 lakhs yen, and the same would correspond to rupees 30 lakhs. Same would correspond to rupees 30 lakhs. Same would correspond to rupees 30 lakhs. Next point, current exchange rate, underline that. Current exchange rate, underline that. Rupees 30 lakhs equal to 108 lakhs yen. Current exchange rate, underline that. Rupees 30 lakhs equal to 108 lakh yen. Rupees 30 lakhs equal to 108 lakh yen. Rupee 1 equal to how much? 3.6 yen. 3.6 yen. Exchange rate equal to yen 3.6 per rupee. Exchange rate equal to yen 3.6 per rupee. Yen 3.6 per rupee. Next point. Exchange rate is expected to decline by 10%. Is expected to decline by 10%, and we are required to protect the yen payments. Full stop. Decline of 10%, decline of 10 percentage will be interpreted, decline of 10 percentage will be interpreted as depreciation of rupee, will be interpreted as depreciation of rupee, full stop. This is because an importer would be worried, about rupee depreciation, slash yen appreciation, slash yen appreciation. Any doubts on this? Next point, expected exchange rate equal to 3.6 minus 10%. My rupee is depreciating, rupee is the product in the quote. We have the given quote is 3.6 yen per rupee. If rupee is the product, I can straight away apply the percentage. I can straight away apply the 10%. The basic rule is your appreciation, depreciation can be applied only onto the product. So in this case, rupee is the product and rupee is only depreciating. I straight away apply it. So less 10% is 0.36. We expect the exchange rate to will become 3. It will become 3.24 yen per rupee. More or less the question is talking about some loss calculation. Loss can happen only when foreign currency appreciates and INR depreciates. So INR obviously has to depreciate in this question. The 10% has to be on INR. Okay, now please listen. Yeah. Think about it and let me know. Yeah, which one is it? Isn't it appreciation? Sorry, I didn't get your question.
Like this 3.24, if you are comparing it with 3.6, it has decreased. So it shows the depreciation of yen.
Think again. Let's take an example. Rupees 68 per USD. Rupees 65 per USD. Rupees 68 per USD. Rupees 65 per USD. What has happened to rupee in this case? First currency, yen is first there, okay? What has happened to rupee in this case? 68, 65. Rupee has appreciated, yen has also appreciated. Clear? Any doubts on this? Then, yeah. I'll note it down. Apple, rupee. Okay, yeah, tell me. Just a minute. 1 apple per rupee. Okay, earlier you were getting 3.6 apple per rupee. Every rupee was to give you 3.6 apples. Now with every rupee you are getting only 3.24 apples, no? 1 rupee is? ठीक है. So basically you are doing this 3.6 apple per rupee. Now you want 3.6 apple per 1.1 rupee. That's broadly the analysis which you want. The basic thing is you are indirectly adding 10% to the rupee, which is not going to work out. So what I have been basically indicating you is your appreciation depreciation percentage has to be applied onto the product. If you apply it on the price, it becomes a mistake. So when somebody says rupee is going to depreciate by 10%, it indicates that whatever you were buying earlier, now you will buy only 10% less. It does not mean you have to pay 10% more. Buying 10% less and paying 10% more has a difference. Why it has a difference? Earlier it was 3.6 apple with 1 rupee. Now what you can get is only 3.24 apple. This is 10% less. Now 3.24 apple per rupee, the moment it becomes, if you have to go back to 3.6, you'll have to add something like 11% rather than 10%. That's why 10% depreciation in one currency will look like 11% appreciation in the other currency. Then only things will work. It is basic rule is because of math called as your denominator can be cost price, denominator can be selling price. So profit can be on cost, profit can be on selling price. Because of this, these percentages make a little bit of a difference. See, normally if I talk to you, I say rupee is depreciated by 10%. It means I normally will understand earlier I was paying 1 rupee, I'll pay 1.1 rupee. There's nothing wrong in that. That's what normal discussion can happen. But if you want an exact interpretation, 10% increase in price of apple does not mean 10% fall in the value of rupee. That's the crux. Now let's proceed. Expected loss equal to now listen for a minute. My expected loss is 108 by 3.6. This is what I would have paid if the exchange rate had remained same, or if I go by the spot rate, minus 108 by 3.6 minus 108 by 3.24. This is the loss I am seeing to happen. This is the amount of loss can happen for me. Why it can happen? Because currency is not moving in line with what I want. I don't want yen to appreciate, but yen is going to appreciate. So this is my expectation. I expect that there is going to be a loss, and the loss is 108 lakhs by 3.6 minus 108 lakhs by 3.24. If things had remained same, I would have paid only 30 lakhs. Or I straight away go ahead and pay today also 30 lakhs. So this is my expected loss. Then I come to the forward contract. Now calculate this. Expected loss. Most of the times exchange rate will look like that you have to add it, deduct it. Unless you go step by step, you will end up making a mistake, because looking at the exchange rate, you will feel it's an appreciation, but in reality it's going to be a depreciation. The things why it becomes a little difficult is because you're not used to working with exchange rate. In your articleship also you don't get an exposure. So because of that, if I give you two exchange rates, or if I give you two quotation, you start struggling with it. Whereas if I say Coke 10 rupees has become 8 rupees, you will clearly say Coke, price of Coke has come down, rupee has, all those are easy to understand. But exchange currencies become a little difficult to understand. So whenever you have difficulty in understanding, spend a little bit of time. And one more thing, as with practice, as you do more and more problems, anyway the comfort level will increase. In an exam scenario, it's okay to spend a little bit more time on at least Forex. Forex is an area where you may end up spending a little bit more time. You will save time at other places. SFM is not going to be lengthy, so completion of paper is not going to be an issue. So in case problems on Forex are there, spend a little bit of a time. If you try to rush up, you will most probably make a mistake. So don't do that. What is the expected loss? 3.33 lakhs. This is the loss I foresee. This is the loss I expect that will happen. I can reduce this to some extent. How can I reduce this to some extent? Is by taking a forward cover at 3.3 yen per rupee. By taking a forward contract at 3.3 yen per rupee. By doing this, will I continue to have loss? Yes, I'll continue to have a loss. But the forward contract will reduce the amount of loss. Next point. The company can take a forward contract. The company can take a forward contract. To reduce. Can take a forward contract to reduce the amount of expected loss. To reduce the amount of expected loss. Full stop. The forward contract will be taken. The forward contract will be taken at the rate of 3.3 yen per rupee. Will be taken at the rate of 3.3 yen per rupee. Next, loss through forward contract equal to, I hope there is no doubt on division part, why I divide by 3.6, 3.3. Loss through forward contract equal to 108 by 3.6 minus 108 by 3.3. Here also we are going to have a loss only because yen is appreciating in the forward contract also. Loss is certain. You can reduce your loss, that's all. How much is the loss? 2 point? The loss can be reduced to 2.73 lakhs. I'm nowhere going to reduce, I'm not going to eliminate the loss, that's not possible. Loss will continue to be there. The only thing is I can bring it down a little, that's all. Any doubts on this? Clear? Can we proceed? Rupees. You have converted, no? All are rupees only. Any doubts on this? Can we proceed? Can we? Okay, let's move to question 4. In March 2012, the multinational industries makes the following assessment of dollar rates per British pound to prevail as on 1/9/2012. What is the expected spot rate for 1/9/2012? If as of March 2012, the 6-month forward rate is 1.80, should the firm sell forward its pound receivables due in September 2012? Now, whenever probabilities are given, expected spot rate is equal to weighted average of the various rates with probability being the assigned weight. Any expected value you want to write. Expected time is equal to weighted average of the various possible time with probability being the assigned weight. Expected NPV is equal to weighted average of the various possible NPV with probability being the assigned weight. Expected return is equal to weighted average of the return with probability. So wherever probabilities are there, you will multiply with the probability. So what you are going to do is create a 3-column format. The next column is probability. Multiply and put product. Just a minute. The 2 columns are already given in the question. The 3rd column will be product. Product is you multiply this and put a total. That is the expected spot rate. So 3 columns: dollar per pound, probability, product. Dollar per pound, probability and product. How much? No, overall amount total. Just give me the overall total. One point? $1.81 per pound. Just a minute. Okay, there's a small mistake. I think this should have been dollar receivable. This should have been dollar receivable. Now you expect the exchange rate to be $1.81 per GBP. Forward rate is $1.80 per GBP. Your expectation is $1.81 per GBP. That's the expected rate. Forward contract is $1.80 per GBP. They are asking, should you sell forward dollar receivable? Okay, let's complete this first. Should you take a forward contract for dollar receivables? Spot rate is 1.81, expected rate is 1.81, and the forward rate is 1.80. Receivables. Take, not take. You can take, you are going to receive $1 lakh and then think and let me know. You are going to receive $1 lakh. Take or not take the forward contract. Take an example of $1 lakh and let me know. $1 lakh example. If you are going to receive $1 lakh, what should I do? Take a forward contract, not take a forward contract? Sure? Okay, if you take a forward contract, what is your realization? If you take a forward contract, what is your realization? 1 lakh? Think again. Is it division, multiplication? It's division, and you should go ahead and take a forward contract. That's why I said think through, don't go in a hurry. If you go in a hurry, you will end up making a mistake. I purposefully changed the question as dollar receivable. This is what the exam scenario was. They made it in a way that it will push you to answer that forward contract is not required. The question will be worded in such a way that you will feel forward contract is not required. Now, if $1 lakh is receivable, let's try to do both the analysis and then come to the answer. Don't go in a hurry. I'm telling you, if you rush through this chapter, you will end up making a mistake. We have been doing this issue 4th or the 5th time. What we feel and what turns out to be is exactly the opposite. So if you try to rush through, you will make a mistake. Now let's try to do the calculation. Now let's assume 1 lakh, right? 1 lakh receivables. 1 lakh receivables. Not taking forward cover, not taking forward cover, not taking forward cover, known component $1 lakh, unknown component GBP. You arrive at a formula and then decide whether it's division or multiplication. Known component $1 lakh, unknown component is, it will be question mark GBP. You arrive at a formula. What is the formula you have arrived at? USD into GBP per USD. 1 lakh into 1 divided by 1.81. 55,000. 55,248.62. That's what you get, no? 55,248.62 GBP. Now you do the same thing if you take a forward contract, and then tell me whether to take a forward contract or not. Let's complete this, then I'll see what is to be done. Let me check the electricity front. One lakh into 1 divided by 1.80. 55,000. Which looks better now? Taking a forward contract. Don't rush through your solution. I cannot explain again. If you rush through your solution, you will end up making a mistake. I'm telling you now also, this is one area where you cannot go in a hurry. The exam question which I remember, they had purposely made it as dollar receivable. They had made it in such a way, if it had continued as pound receivable, your answer would have been right. If it had continued as pound receivable, the question had continued as pound receivable, you will multiply with 1.81, you will multiply with 1.80. Obviously, multiplying with 1.81 is better, but we are not multiplying, we are dividing. And when I divide it, as I want to divide it by a lower rate rather than a higher rate. So don't rush through the solution. This is one area where if you rush through the solution, you will end up making a mistake. There's no other way. If you rush through the solution, you will only make a mistake. I don't have any other way of teaching you this. Forward contracts, international finance, your gut feeling will say that this has to be done, and it will most probably the opposite of it. Most probably. And wherever INR is not there, you will end up surely making a mistake. If INR at least is there, things will be easier for you to understand. This question INR was not there. So if you rush through the solution, you will end up making a mistake. I was explaining this in the last question because I know this was coming. So that's when I explained it, saying that don't rush through the solution. We again ended up rushing through the solution. It's okay to take that extra amount of time, known component, unknown component, deriving at the formula, dividing, multiplying. It's okay to take that amount of time. You will feel you will have to take bid rate, it will turn out to be ask rate. You will feel ask rate is to be taken, it will turn out to be bid rate. All of these issues will be there.